my name is Luluk Huwaida. You can call me Luluk. I'm from Accounting C, University of Muria Kudus. Today, we're going to talk about balance sheet.
Balance sheet helps you see the big picture, things like the value of your business, how much you owe others, and how much is left over for you, the business owner. A balance sheet is a must-have if you ever want to speak with investor, secure a loan, or sell your business. In short, you definitely need to know your way around a balance sheet. In this video, we'll walk you through exactly what a balance sheet is, what it looks like, and how to create your own. We'll even give you a template for your own so you can start plugging your number in. So, let's get started. A balance sheet is a financial statement. It's one of the big three financial statements, along with the income statements and cash flow statements. A balance sheet gives a snapshot of your financial at a particular moment, summarizing every transaction and journal entry since your company launch. A balance sheet is divided into three sections: asset, what your business owns; liabilities, what it owes others; and owner's equity, which is the owner's claim to the business. Because it summarizes so much financial information, the balance sheet is sometimes called the statement of financial position. Companies usually prepare one at the end of a reporting period, such as the month, quarter, or year. There are three main reasons you'd want to create a balance sheet for your business. Number 1. Investors and leaders require them. People who give your business money want to know exactly what they're getting into. The balance sheet is the best way for them to see the big financial picture. So, if you want to raise any capital, you'll need a balance sheet. Number 2. Show you the layer underneath income and expense. How much money you earn and spend isn't all there is to your business. Do you have any loans? Have you ever broke equipment? Do you have a patent? Do you have a bunch of unpaid invoices? You may be making way more than you spend each month, and that's a great way to start having a healthy business. But without understanding all those assets and liabilities that lie underneath that monthly revenue, you won't really know how much your business is worth. Number 3. So you judge how valuable your business is. Maybe your business isn't bringing in as much net income as you hoped it would, and you're discovered at your financial prospect. Sometimes that doesn't tell you the whole picture. The balance sheet can remind you of all the assets you've invested in the past and how much those are worth to you. Maybe you're starting with revenue, but you have no debt, and some solid long-term asset you can sell off, so you can start a new business on a better foot. The balance sheet gives you that big picture awareness, how valuable your business really is. It's called a balance sheet because the asset section will always balance with the liabilities and owner equity section. That's the balance sheet formula. Asset equals liabilities plus equity. If your asset don't equal liabilities plus equity, then you've done something wrong. Let's take a look at an example to see how this works. This is Disney balance sheet for the year 2018. Well, a very simple version of it. A lot of things have been left out. There are three main sections. We've got assets and liabilities and equity. You can see here that the total liabilities plus equity is the same as the asset. In other words, they balance. Now, what can you actually learn from a balance sheet? Let's pretend we're the CEO of Disney reviewing our balance sheet at the end of the year. Our accountant hands us our balance sheet, and this is what we see. The first thing we see is that Disney has too much current liabilities. How do we know that? Because their current liabilities are much higher than current. current assets, current liabilities are any debt you're going to have to pay back within the next 12 months. And current assets are cash, and assets you plan to turn into cash in the next 12 months. As it stands right now, Disney has a problem. They don't have enough current assets to cover their current liabilities. Accountants call this idea the quick ratio. It means ideally you want to have one-to-one ratio of current assets to current liabilities. Now, I'm sure Disney is going to be just fine. They can probably restructure this debt and they are probably going to earn more than enough revenue to cover this debt in the form of movie sales, music sales, and Disney ticket sales, and etc. Their cash flow statement will provide more detail on the cash flow side of things. The second thing we can learn at a glance from this balance sheet is that Disney has $38 trillion in goodwill and tangible assets, which is the single most valuable thing on the balance sheet. Goodwill and tangible asset, which is the single most valuable thing on the balance sheet. Goodwill and intangible assets are essentially the value of the Disney brand. The only problem with that is the Disney brand doesn't pay the bills. If you want to sell the Disney brand, who would have enough money to buy it? And how long will it take? Okay, that's the balance sheet. I hope you enjoyed watching. Have a go at the question that follow up and then move on to the next video. Bye bye.